with that being said, let's shift over. If anyone has questions, please use the Q&A box and I will do my best to track that. I am going to speak for, I'm looking for something that I dropped here. Give me a second. Okay, I am going to speak for probably the next 10 minutes or so, and then I'll open it up to Q&A. Today, we're going to speak about, give me 1 second. Okay, I'm going to speak about assuming a multifamily loan in today's market. So as I said at the beginning, right, we're in a market now where interest rates are rising, which allows you the opportunity to potentially acquire a property with a debt assumption. So you'd be assuming the debt that the seller has in place for the property. For example, if a seller bought a property within the last 5 years or so, and it was an agency loan, it may be beneficial to evaluate, instead of trying to get new debt on the property, you may want to evaluate assuming the debt that is already in place. If this was an agency loan, let's say it was a 10-year fixed loan, they may have a lower interest rate from their loan that you could assume than the interest rate you would get on a new loan. The biggest kind of pro and con to the loan assumption, the benefit is if you can assume a loan and it has a lower interest rate, you would obviously be saving on interest. The biggest drawback, and why in most cases a loan assumption wouldn't work for most investors, is because you would be buying the property for a larger sum of money than the seller previously bought the property for. And so you could have a very large down payment with the assumed loan being very low leveraged. So what do I mean by that? Let's say you bought a property 5 years ago for $10 million. And at the time they got a 70% loan to value. And let's just say it's a 10-year fixed loan with 10 years of IO. So I don't have to do any P&I amortization in my head. And it's now been 5 years. That loan would have 5 years left on its payment schedule before the loan needs to be paid off, where you would either need to refi or sell. So the 70% loan that was created when the seller bought the property 5 years ago would have $7 million in debt on it. Let's say today you're going to buy the property for $14 million from the seller. Well, if you did that, the down payment you would need to bring is $7 million plus all of your closing costs and any fees, because you would assume the $7 million in debt that the seller is allowing you to assume. So it doesn't make the most sense from a return perspective. If you're underwriting the deal and looking at IRRs or your cash on cash returns, bringing $7 million in equity and getting $7 million in debt to buy the property today for $14 million may not make the most sense to have a 50% levered deal. However, there are some unique situations where that may be very beneficial. If you have a large equity amount you need to place into a deal, if you have several 1031 investors that, again, need to place a lot of equity into a deal, you can certainly make things work. And maybe you can buy a property at a slight discount depending on what the seller situation is, and also regarding prepays. the logical kind of underwriting steps still need to be thought through and reviewed, whether you are assuming a debt or looking at putting new leverage on a debt. When we look at some of these loan assumption deals, we will typically create two underwriting models, one with the assumed debt terms underwritten, and then a second model if we were to acquire new debt for the property at today's market kind of debt terms and rates. And so it's really important to evaluate both of those options to ultimately determine what is the best option for your investment. There is definitely an opportunity in today's marketplace, just with rising rates, to potentially create a little niche buyer profile if you are able to bring a lot of equity to deals. Then you might be able to find a little niche where you can assume sellers' loans and have it be a win for you as well as a win for the seller. And like I said, it might be possible to get a little bit of a discount if you're going to help the seller out and assume the loan, help the seller kind of avoid a prepay penalty or things of that nature. But it may be also beneficial to lock in some really good rates. For example, on a couple of agency loans that we did in late 2020, we were locking in interest rates on loans with 20, 30, $40 million in debt at sub 3% all-in interest rates, which is really, really good. Today's rates for agency loans at that level is probably somewhere around high 3%, maybe mid 4%, depending on location, property type, and any other, property specific information. But those rates are really hard to come by nowadays. And so that's where the benefit could be, is if a buyer could assume that really good interest rate from a year or 2 or 3 ago, it's probably going to be cheaper than it was back then. But again, the option exists. Not that you have to do it all the time. I think, again, it could be a very good niche for you as a buyer to be in if it works for the deals and if you have the proper equity structure to be able to manage that larger equity need there. Let me pause for a moment and answer any questions. So if you have questions, go ahead and use the Q&A box or use the chat box, and I'll do my best to manage both of those. Let me ask this question. Use the chat box. Has anyone assumed a loan that's joining us live on the webinar? Has anyone assumed a loan for a multifamily deal who's joining us live on the webinar? Go ahead and answer that in the chat box or the Q&A box, and we will go from there. All right, very good, Hugo. Trying to assume a loan now. Do you have any questions or complications to the process? It's very similar to a normal closing or a normal acquisition. The time frame can be a little bit longer because the lender will require special approval from the master servicer of the loan. So if you are underwriting a 30-day due diligence and a 30-day close, between you and the seller, of course, the seller is going to be working very closely with you to help you get the assumption paperwork done. But the process could take sometimes up to 90 days because the master servicer of the loan will go through some sort of special approval process. Was bidding on one. Okay. All right. So people are very familiar with it, it seems. Let's see. Is there such a thing as wrap loans with multifamily? Kevin, I'm not sure what that question is specifically related to. You may be thinking about a supplemental loan. And so, one of the strategies that people have, if they're going to assume a loan, let's go back to my original example. You buy the property today for 14 million, you assume the 7 million in debt that the seller has, and you bring 7 million in equity. One of the things that people will do is underwrite to get a supplemental loan from the lender, from the agency lender, and um, maybe the 7 million in equity you bring day one, maybe you can get 2 million in a supplemental advance. And so you have to bring 7 million to close, but then once you close, you can close on a supplemental loan, get 2 million more dollars in debt from the lender, and you would have 5 million in net equity invested. All right. Let's see here. One of the questions is from Rob here. The seller owns the property outright. I would just see what the seller is interested in, if they would seller finance it to you. Any owner or seller is pretty savvy. I feel like they stay up to date on the terms. But again, the seller finance approach is one of those opportunities where it could be a win-win, a win for the seller, where they're not having to recognize a huge amount of gains. So they would maybe take some sort of market rate interest, similar to kind of what you would pay a traditional bank or lender. So I would say, Rob, throw out some sort of idea, see what kind of feedback you get from the seller. Maybe they would seller finance the deal to you at, 4, 5, 6% plus interest rate. Again, that's really between you and the seller. It depends on the property type, the situation, the location, the needs of the seller. So a lot of different variables, but always ask the question. The worst they can do is say no. What are the usual agency loan costs to the seller who is having their loan assumed? Typically, there is some sort of assumption fee that's in the loan agreement. It's negotiable. Either the seller can pay that assumption fee or the buyer can pay that assumption fee. So it's possible that the seller may not incur any fees at all. Very good. I think I've covered every question in here. Again, the takeaway is, if there's an opportunity to assume a loan, don't just pass on the deal, but go through the process, underwrite it both ways, look at it with new debt based on today's marketplace, and evaluate your underwriting using the assumption terms and see if that deal can work for you. Again, I think there's a real niche opportunity here for buyers who are really ready, willing, and able to assume loans. I think you could see a good kind of deal win percentage from sellers that are looking for buyers to specifically assume the loans. The loan to cost here, Keith, last question. It really depends on what the deal makeup is and the structure. You could see some sort of LTVs around the 50% mark. You could see some LTVs around like the 40% mark. So it depends, as well as the supplemental. Always ask the lender when you get a deal under contract what the capabilities of the deal to support a supplemental loan could be. And you should know before you acquire a deal or do anything with that. With that, I am signing off. Thank you, everyone, for joining us and going through the assumption of a loan presentation. Also, don't forget mfincon.com, and we will see you in Charlotte. Get your ticket. We'll see you in Charlotte. Thank you, everyone. Have a great day.